Hey guys, I'm Nick, and this is Tony, and we're the Sicilian Brothers. We're here today with TJ Kosen, and we're going to talk about the new Ginnie Mae 40-year loan mod email that just came out.
So there's an article that came out this week, and the headline was something along the lines of Ginnie Mae announces a securitization of modified mortgages up to 40-year term.
I can get a 40-year loan?
No.
I want a 40-year loan. How
No.
do I do that?
No.
I can't do that?
No.
Damn.
That's the clickbait of the headline,
Oh,
right?
I just read the headline. That's my problem.
Right.
I didn't read the article.
If you
read?
if you would open the article and read the article, it's
What's the article say?
The article is actually explaining that they are toying around with the secondary market to decide whether or not there's an appetite in the bond market for a pool of loans for modified, so someone's in default and they need to do a modification on their loan. If we give this buyer, you and Sarah, for instance, need a modification. If
my rehabs are going kind of slow. I might need to postpone some payments.
If they give you 40 years and we take 100 of those, is there a market for it in the secondary market? That's all that Ginnie Mae is exploring right now. They're not actually offering 40-year loans.
So I can't go to my favorite loan officer.
Correct.
And say, hey, bro, I need a 40-year loan.
Right.
Instead of my 30-year loan.
Right.
Can I get a 20-year loan?
Yes, you can get a 20-year
15?
loan. If you qualify.
Not 40?
Not 40.
Why not?
Because it doesn't exist, and I think it's already too long, right? But it gives people the opportunity to lower their payment. I mean, if you do some of the math on it, the payment difference between a 30-year and a 40-year loan on average is probably like $100. But it's compounded interest. It's just insane.
So
right?
this is for folks that are in default or in forbearance.
Yes.
That need a workout, basically in a loan mod type of situation.
Correct.
And what? Ginnie Mae?
Ginnie Mae, yes.
Which one
the
are
cousin.
they? So there's
Which
Freddie,
cousin?
Fannie, and what's Ginnie do?
So
Is she the one that says "Run, Forrest, run"?
So Ginnie, I love you, Jenny. That's Jenny, and
not Ginny.
this is Ginnie.
Okay.
So
Ron's sister.
Ginnie Mae is literally still a part of the government, whereas Fannie and Freddie were privatized.
Okay.
So Ginnie Mae is still a part of HUD, right? So it's still a part of the Housing and Urban Development Department, right? So they basically are the government entity that blesses securitization with our governmental money.
Perfect.
Okay. So they're playing around with our money, saying, "Hey, we're going to offer it on a longer term to give someone the ability to have a lower payment."
So
This is to lower payments, push out fear of default and stuff like that, right?
Yeah.
They have to be in default before they're even accepted for that loan mod.
Yes.
So
It is someone. The terms are they have to owe 361 or more payments.
this 360 is 30 years.
360 is 30 years. So you have to already be behind. And so it's relatively speaking, it's someone that bought a house in the last 12 to 18 months and hasn't made a payment and is behind.
right. So then they get the option potentially, if this becomes policy,
Correct.
of extending the loan term to 40 years
Right.
through a loan modification process.
Right. And it restarts the loan. Basically, they refinance into a 40-year loan from a 30-year loan, resets their payment to less, and they're able to, theoretically speaking, afford the house again.
So have they talked at all about other qualifications? So do I have to still have a job, or am I just rolling this over?
They did not.
So let's do this and let's redefault. Let's default a second time.
Yeah, they are. This is one of the reasons why I wanted to talk about this, was because there's been so much. It's been posted out there a few times, and people are like, "Oh my gosh, there's going to be 40-year loans. What does that mean?" And I don't want to get into the hype. Yeah, the hype of it all. I'm just trying to explain the article. The article is they're exploring. They're not even doing it. They're exploring. They're thinking about it, offering a modified 40-year loan to see if the back end bond market will hold those loans. Right.
And that's a cynical maybe outlook too, because there's also the intention is at least of having this be a good product for the consumer. So then that brings us to the other side of the equation. Is this a good product for the consumer? For the defaulted consumer first.
First, for the defaulted consumer, right, you're going to have those people that do bad, right? And then you're going to have those people that have bad things happen to them. And so, yes, there are plenty of people that have had bad things happen to them in the last year. And so they absolutely deserve a chance to keep their home, make it right, get a modification, and keep going.
So
right?
let's take maybe an example of that. So I know a lot of sales guys that would travel all over the country to sell, whatever medical supplies or whatever it is.
Right.
And those jobs, they're mostly commission based generally. Even if they're stable, they've been there 5, 6, 7 years. A lot of that went virtual, but for the first several months, maybe 3, 4 months, the job just kind of disappeared. So at that point, you're talking about someone who had a stable job for maybe however long. Well, it takes at least 2 years to qualify.
Right.
But had a stable job for a while, and then all of a sudden that stable job isn't there, and maybe it takes 6 months for the marketplace to reevaluate how to put that job back in the marketplace.
Yes.
Through a virtual perspective, or through Zoom calls, or through however it is.
Or retraining, right?
Right. So if your mortgage is say $2,000, 6 months, $12,000. Not everyone can just come up with $12,000 in interest carry.
So
and cover their other living expenses.
Right. That's part of the argument about modifications.
Right.
It's hey, there was a lot of, and this is why it's up to everyone to do their due diligence and understand because your loan on your house is very different than my loan on my house. 2 completely different lenders, 2 completely different financial situations, right? They're just 2 different loans. They might
more than likely different amounts of equity left in the house, that type of thing as well.
Right. So I definitely have more equity than you. But the thing really is that you have a situation where I lost my train of thought. I made a joke and I lost my train of thought.
Try not to talk over each other.
How much is how much equity you got in your house?
Probably like 300. So
I only got 280.
So yeah, I think the point to be made here is that the fact that they're even toying around with this means that this is the very, very edge of, in my opinion, the future of conventional loans going to longer term.
So why don't we have 40-year loans now? And why do we tend to generally cap residential conventional loans at 30 years?
That's a really good question.
Because it's been different in the past. So
yeah,
why can't
we
it
had
be,
50-year
why
loans.
can't it be different in the future?
It can be. It can be. If there is a market for someone to sit there and wait.
So part of the appetite in that then has to be loans get pooled into big old giant pools, sold off on the bond market. And the idea is if you pool 100 loans that are all $100,000 and they're all at, say, an aggregate, 4% or whatever it is, then that's going to be a relatively stable asset that people can then invest part of their retirement into.
Right.
From a bond perspective, they maybe pension funds, public retirement accounts can invest into that as a long-term, relatively stable asset.
Yes.
So the issue is obviously, well, what happens if interest rates are, I just said 4%. Well, what happens in 5 years if interest rates get up to 6.5%? Then what happens to the value of that bond pool?
Well, the good thing is that bond pool is already traded, and it's already received its return for that period of time. But let's not mistake, we're talking about mortgages. Just because we're giving someone a 40-year mortgage doesn't mean that it's going to last 40 years. Nothing is changing the fact that the average mortgage life is 5 to 7 years. So you're nothing's going to change that.
Right.
Nothing's going to, that's still going to be the case, right? So you're going to have paid more interest than you currently are on a 30-year loan, right? On the 40-year loan, and so you're going to build less equity or whatever.
You're going to build up equity slower.
Right.
So does this? What happens if I feel like being a really diligent individual and I want to pay an extra $100 a month on my loan even though I now have a 40-year loan.
I think that's a very right now you're a savvy homeowner who is accelerating the loan.
Am I a good real estate investor?
Sure, because you're adding to, well, and I guess that would come into play. Are you an older real estate investor that's trying to get to equity, or are you maybe a younger real estate investor that's parking the cash, whatever it is, right?
Right.
So that kind of comes into play as to who you are as the investor and what your goal is.
So the answer is it depends.
Absolutely.
So when I see an argument on Facebook with someone calling out someone else for being wrong about something in their personal finances,
yes,
the answer is they're both right, they're both wrong, or the one doing whatever it is that they're doing is right.
I think the person that's making their decisions for themselves is right. I don't think there's a wrong.
I think you can run the risk of having there are absolute wrongs that are just dumb in the marketplace. But I think there is a lot of, does it work well for the individual client in their circumstance?
Right.
And so what does that mean with this product? Does this product work in general, you think, relatively well for the client that's in default, like our sales guy that was out of work for 6 months?
I think it gives them the chance to keep the American dream alive. And so do I support it? Sure. Do I think everyone deserves a 40-year loan or should go get 40-year loans? No, I also don't think that everyone should go get a reverse mortgage. There is no cookie-cutter answer for every single American. That's just not the way the world works.
The way I read this, though, is that they're talking about allowing people to hit the reset button in a sense, right? Like they're allowing people to modify their debt and then push out something like that, right? Where if the sales guy, if he's 6 months out and they don't offer him that loan mod, he's going to have to sell. He's going to have to get out of there.
Yeah.
Right?
So they're already offering these people loan mods. But sometimes, given, let's take the salesperson, he lost his job, right? And now he finds new employment, and maybe now it's not on the road anymore. He gets a new job in the town in which he lives. So lives in Dallas. His house is in Dallas. He used to travel all over the country. He was in default on his house in Dallas because he can't travel. So now he gets a job in Dallas. But maybe it's not commission-based. So maybe he's not making the big paydays that he was making. Maybe now he has to retrain himself to live on a smaller income without travel, so maybe less expenses, right? And so they're giving that person the ability to kind of retrain his financial life and kind of put his life back together, right? In theory, that's what the modification does. They're already doing this with loan modifications, but there is no appetite for a 40-year loan. So the longest you could do is a 30-year loan, right? So if again, let's take Bob. He bought his house 12 months ago. So, and he's, or 18 months ago, and he's 12 months behind. So he owes more than, the 30. He hasn't made a payment, right? So he owes 30 years and 1 month. So if you were to take him from 30 years and 1 month and put him back on a 30-year, his payment's going to go up. The only way to get his payment down is to have his mortgage insurance or Fannie and Freddie or Ginnie eat interest and write off debt, right? That's the only way to reduce Bob's payment, is to reduce his loan amount, which someone is going to literally take a loss for Bob to keep his house, okay? But that's what PMI is for, the greater pool of interest, mortgage insurance, right? Or don't eat the debt, kick the can 10 extra years, which allows him to qualify and give him a lower payment, right? And give him the opportunity to hit the reset button on his life. So I understand why they're doing it. They're already doing it now. And the average person qualifies right now because 12 months ago or 18 months ago or 24 months ago, their interest rate was probably higher than what we can retrade that debt on now, right? So if you were at 4.5 and today you're in default and you go into a modification at 3.5, ideally they can afford to raise your loan amount and roll in the 18 months of payments and still keep you at the same payment, and you would qualify, you go back to work, still make the same payment, and hit the reset button on your life.
Same spot.
Right? Yep. And still be in the same spot. So I understand why they're doing it, why they're toying with it, but I think that it's a slippery slope if all of a sudden you now open that pool to the retail market and start giving mortgage brokers the ability to write
affordable loans to people that shouldn't afford them.
Yeah.
Well, possibly, yeah.
You know, I mean...
Well, the issue also on a broader spectrum is if there's a 40-year loan, inherently the payment on the same principal amount is going to be less,
Yes.
which means that the affordability is greater in a submarket, or, well, nationally the affordability is higher, which higher affordability tends to also drive up and increase prices and things.
And it's kind of a scam in a way, right? Because you're making it affordable, but adding so much. And what people don't realize,
Well, you're adding 30%
is
to
you're
the
adding
loan, to the loan period.
You're adding a massive amount of front-loaded interest, right? So the difference between auto loans and house loans are auto loans are simple interest, right? So they don't change how much you pay when you take a loan out on your car at 2%. It's automatically the same interest and principal for the length of 5 year, right? On a 30-year mortgage, you're paying, the graph of which you're paying interest is all front-loaded. So the bank's getting their return. So now you're just giving the bank a greater 10-year, front-load interest.
So is this a big conspiracy to keep people in a low equity situation in their properties?
I don't know.
The big banks getting together?
I think someone has a heart and is trying to figure out if there's an appetite. Look, there are other countries out there that have long-term loans, 50-year loans, 60-year loans. I think there's a country out there that has 100-year loans. I don't not necessarily support them. That's not something the United States has been used to. So this is an interesting way to start to maybe keep up with the inflation word that we were referencing in our previous video. So who knows what but it definitely is the writing on the walls that there's something potentially coming from the secondary market that will change homeowners, like home ownership loans.
I think it's definitely an opportunity for people to hit the reset button, lower their payments, but it's gonna allow properties to keep on appraising, keep on increasing, appreciating. Yeah. It's giving them that opportunity to keep on growing.
Yeah, because again, by
different markets,
by keeping the default ratio down, we're preventing losses. We're right,
and you're constraining inventory basically,
yes,
because you're not having foreclosures.
Correct.
Whether or not those foreclosures are justified,
right?
And you can argue kind of either way depending on where you want to be through the pandemic.
Correct. Yes. So I think there's obviously goods and bads coming out of it. I think the point of me talking about it today was like, hey, this is not. Don't go call Bob or Kenny, your mortgage guy, and say, hey, I heard that they're doing 40-year loans. That's not.
No, but also read the writing on the wall. This is an opportunity for continued growth, right? Like there's something there that is allowing appreciation to keep on growing.
Yeah, well, and also you if you are one of those people that's in Bob's situation where he lost his job and you want to do the right thing and you want to keep your house and you want, right? This is light at the end of the tunnel that, oh my gosh, they're actually listening to us and they're going to give us the opportunity to actually save our house and lower our payments, and we'll be able to, hopefully learn from it and come out, on the other end positively, right? So there is some good out there for it. So I'm interested to see if it comes to fruition and what the secondary market, holds for it. So
and what the long-term effects will be. It should be fun.
Yeah, absolutely. All right, well, that was a lot to digest there, and hopefully some clarification on the topic of Ginnie Mae and their 40-year product that they're exploring. Thanks for watching, guys. If you have any questions, comment, like, subscribe, share, and reach out to us. And remember, keep going.